Hello and welcome. Take a moment and think about the last time you truly felt at peace about your finances. For many of us, that feeling can be elusive. Instead, money often brings a sense of anxiety, confusion, or even fear. It's that knot in your stomach when an unexpected bill arrives, the quiet worry about whether you're saving enough for the future, or the simple frustration of feeling like you're working hard but not getting ahead. If any of this sounds familiar, I want you to know you are not alone. And more importantly, I want you to know that there is a way to change it. This series is your first step on that journey. Before we dive in, it is absolutely essential to state that the information provided in this entire series is for educational and informational purposes only. I am not a licensed financial advisor, tax professional, or legal expert. The content shared here is not intended as, and should not be considered, financial, investment, legal, or tax advice. The financial landscape in the United States is governed by strict laws and regulations. Personal financial situations are unique, and any decisions you make should be discussed with qualified and licensed professionals who can assess your individual circumstances. Our goal here is to empower you with knowledge, so you can have more informed conversations and make confident decisions for yourself, under the guidance of experts. So with that crucial understanding in place, let's talk about our topic, financial literacy. It's a term you may have heard before, but what does it actually mean? Financial literacy isn't about being a math genius or a Wall Street wizard. It's not about memorizing complex formulas or predicting the stock market. At its core, financial literacy is simply the ability to understand and effectively use various financial skills, including personal financial management, budgeting, and investing. Think of it like learning a new language, the language of money. Once you understand this language, you can navigate the world with more confidence and control. It's about knowing where your money comes from, and more importantly, where it's going. It's the difference between your money controlling you, and you controlling your money. This isn't a skill reserved for the wealthy. In fact, it is the fundamental tool that most people use to build a life of financial security and freedom, regardless of their starting point. Why is this more important now than ever before, especially in the United States? The world has changed. Gone are the days when most people worked for one company their entire lives and retired with a comfortable pension. Today, the responsibility for financial well-being rests almost entirely on our own shoulders. We are our own financial managers. We are responsible for managing our income, navigating debt from student loans or credit cards, saving for retirement in 401(k)s or IRAs, and protecting ourselves from unexpected life events. Without a solid foundation of financial knowledge, navigating this landscape can feel like trying to sail a ship in a storm without a map or a compass. Let's paint a picture to illustrate the change we're talking about. Imagine a person we'll call Alex. Alex makes a decent income, but constantly feels broke. Money comes in, and it just seems to disappear. Credit card statements are a source of stress, so they're often ignored until the last minute. The thought of retirement feels like a distant, impossible dream. Alex is reactive. Financial life happens to Alex. A car repair or a medical bill becomes a full-blown crisis, often leading to more debt and more stress. The cycle continues, and Alex feels trapped, working harder and harder just to stay in the same place. Now let's imagine another person, Taylor. Taylor might even earn the same income as Alex. But Taylor has spent time building financial literacy. Taylor has a budget, not a restrictive, punishing document, but a simple plan that outlines where money will go each month. This plan ensures bills are paid, savings are set aside, and there's still room for enjoyment. When Taylor gets a credit card statement, it's reviewed, not feared, because the spending was intentional. Taylor understands the difference between good debt and bad debt, and has a strategy to pay it down. Retirement isn't a source of anxiety, but a goal that is being actively worked towards, one small, consistent contribution at a time. Taylor is proactive. Financial life is directed by Taylor. An unexpected car repair is an inconvenience, not a catastrophe, because there's an emergency fund set aside for exactly this type of situation. The difference between Alex and Taylor isn't their income. It's not luck. It's knowledge. It's empowerment. Financial literacy is the bridge that can take you from being an Alex to being a Taylor. Many people are held back by a few common myths. Let's address them head-on. The first myth is, I'm just not a math person. The great news is, personal finance is about 80% behavior, and only 20% head knowledge. It's less about complex calculus and more about simple addition, subtraction, and most importantly, your habits and mindset. If you can count, you have all the math skills you need to get started. The second myth, It's too complicated and overwhelming. The world of finance can certainly seem that way from the outside, with all its jargon and acronyms, but we're going to break it down. Throughout this series, we will tackle one concept at a time, in plain, simple English. The goal isn't to become an expert overnight, but to build your knowledge brick by brick, creating a strong and stable foundation. And the third, most damaging myth: financial planning is only for rich people. This could not be further from the truth. Financial literacy is the very tool that enables people to build wealth and achieve financial stability. It is the roadmap that anyone, from any income level, can use to improve their situation. It's not about how much money you have right now, it's about what you do with the money you have. Over the next chapters, we are going to embark on a practical journey together. We will transform abstract concepts into actionable knowledge. We'll start with the absolute bedrock of financial wellness: understanding your cash flow and creating a spending plan that actually works for you. From there, we'll dive into the world of debt, learning how to manage it, reduce it, and use it wisely. We will explore the power of saving and introduce the concepts of investing for the long term. We'll demystify credit scores, explain the basics of insurance, and touch on how to plan for major life goals. Your journey to financial freedom doesn't start with a winning lottery ticket or a sudden windfall. It starts with a decision. The decision to learn. The decision to take control. The decision to build a better future for yourself, one step at a time. The fact that you are listening to this right now means you have already taken the most important step. You've decided to start. Welcome to the path of empowerment. Welcome back. In our first chapter, we talked about the power of financial literacy as a tool for empowerment, a way to move from a state of financial anxiety to one of control and confidence. We established that this journey begins with a single decision to learn. Today, we take the next practical step. We're going to build your financial compass and draw your personal map. We're going to talk about mastering your cash flow. As a reminder, the content in this chapter, and throughout the series, is for educational purposes only. It is designed to provide you with general knowledge, and is not a substitute for advice from a licensed financial, legal, or tax professional. Every individual's situation is unique, so please consult with a qualified expert for guidance tailored to your specific circumstances. Now let's talk about the single most foundational skill in personal finance: understanding where your money is going. Many people hear this and their mind immediately jumps to one word: budget. And for a lot of us, that word carries negative weight. It sounds like a diet, full of restriction, sacrifice, and saying no to everything you enjoy. It sounds like a chore. So for the purpose of our journey, let's throw that word out. Instead, let's call it a spending plan, or a conscious spending plan. The goal isn't to restrict you. The goal is to empower you. A spending plan doesn't tell you that you can't spend your money. It ensures that you are spending it on the things that you truly value, the things that move you closer to the life you want to live. It's the difference between looking back at the end of the month and wondering where your money went, and telling your money exactly where to go from the very beginning. It puts you in the driver's seat. So, how do we build this spending plan? You can't draw a map to your destination if you don't know your current location. The first step, then, is simply to find out where you are. This means tracking your spending. For one full month, just 30 days, your only job is to become an observer of your own financial habits. The goal here is not to judge yourself or to change your behavior just yet. It is purely an exercise in data collection. You need to see the raw, honest truth of your spending habits. Every coffee, every subscription, every grocery run, every online purchase, everything. There are many ways to do this, and the best method is the one you will actually stick with. If you're low-tech, a small, simple notebook and a pen that you carry with you can work perfectly. Every time you spend money, you write it down. If you prefer something digital, a basic spreadsheet on your computer or phone, using something like Google Sheets or Excel, is a fantastic tool. You can create simple columns for the date, the item, the category, and the amount. And of course, we live in a digital age, and there are many secure financial apps designed specifically for this purpose. They can often link to your bank accounts and credit cards and automatically categorize your spending for you. The tool itself doesn't matter. What matters is the act of tracking. This 30-day period will be one of the most eye-opening financial exercises you will ever do. It's where you find the aha moments. You might discover you're spending hundreds of dollars a month on lunches out when you thought it was only a small expense. You might find forgotten subscriptions silently draining your account each month. This isn't a moment for guilt. It's a moment of discovery. You now have your data. You have your starting point on the map. Once your 30 days of tracking are up, it's time to analyze what you found. Sit down with your notebook, your spreadsheet, or your app, and start grouping your expenses into categories. Generally, they fall into 3 types. First, you have your fixed expenses. These are the costs that are roughly the same every month. Think of your rent or mortgage, your car payment, your student loan payment, and your insurance premiums. They are predictable and form the foundation of your financial obligations. Second are your variable expenses. These are the costs that change from month to month based on your usage and choices. This category includes things like groceries, gasoline for your car, utilities like electricity, and entertainment like going to the movies or dining out. This is often the area with the most flexibility. The third and often overlooked category is irregular expenses, sometimes called sinking funds. These are the large expenses that don't happen every month, but you know are coming. Think about holiday gifts, annual car registration, semi-annual insurance payments, or a new set of tires. These expenses often feel like emergencies, but they aren't truly surprises. By planning for them, you can set aside a small amount of money each month, so when the bill arrives, the cash is already there waiting. This alone can eliminate a huge source of financial stress. Now that you've tracked and categorized, you can see the complete picture of your financial life. You know how much money is coming in each month, your income, and you know exactly where it's been going, your expenses. You are now ready to create your forward-looking spending plan. A popular and simple framework to start with is the 50/30/20 guideline. Please remember, this is not a strict rule, but a flexible guide to help you get started. The idea is to divide your after-tax income into 3 buckets. 50% for your needs. This bucket covers all of your absolute necessities, your fixed and essential variable expenses. This includes your housing, transportation to get to work, essential groceries, and utilities. These are the things you must pay to live. 30% for your wants. This is for your lifestyle choices. It includes your hobbies, dining out, streaming services, vacations, and any other spending that enhances your life but isn't strictly necessary for survival. This framework specifically gives you permission to spend money on things you enjoy, guilt-free, because it's part of the plan. 20% for savings and debt repayment. This is the portion of your income that works for your future self. This includes paying down high-interest debt like credit cards, building up your emergency fund, and saving for retirement or other long-term goals. Your percentages might look different, and that's completely okay. If you have a lot of debt, you might need your savings and debt repayment slice to be larger for a while. If you live in a high cost of living area, your needs might take up more than 50%. The power of this guideline is in its simplicity. It forces you to think about your priorities and to be intentional with every dollar. Your spending plan is a living document. It will change as your life changes. The goal is not perfection, it's progress. It's about creating a conscious connection between your money and your values. It's about giving every dollar a job to do. In our next chapter, we'll address one of the biggest items that can weigh down any spending plan: debt. Now that we have our map, we'll learn how to get rid of the heavy baggage that's slowing us down on our journey to financial freedom. I'll see you there. Hello and welcome back. In our last chapter, we drew our financial map by creating a conscious spending plan. We identified where our money is coming from and gave every dollar a specific job to do. For many of us, a significant portion of those dollars goes to one destination: debt. Debt can feel like a heavy weight, chaining you to the past and holding you back from building the future you want. Today, we're going to talk about how to strategically break those chains. As always, let's begin with our important reminder. This content is for educational and informational purposes only. The strategies discussed are general concepts in personal finance and should not be taken as direct financial, legal, or tax advice. Debt management can be complex, and I strongly encourage you to speak with a qualified financial counselor or a licensed professional who can provide advice based on your personal financial situation. Our goal today is to arm you with knowledge so you can better understand your options. First, it's important to understand that in the modern financial world, not all debt is created equal. Experts often talk about the difference between good debt and bad debt. Good debt is typically defined as money borrowed to purchase an asset that has the potential to increase in value or generate income. The classic example is a mortgage. You borrow money to buy a home, which over the long term will hopefully appreciate in value. Another example could be a student loan. If it enables you to earn a degree that significantly increases your lifetime earning potential. These debts are generally seen as investments in your future, and often come with lower, sometimes tax-deductible, interest rates. On the other side of the spectrum is bad debt. This is typically debt used to pay for depreciating assets or consumption. Things that lose value over time, or are gone once you've used them. The most common form of this is high-interest credit card debt. Using a credit card to pay for a vacation, new clothes, or expensive dinners means you could be paying for those items for years, with interest making the final cost far higher than the original price. High-interest personal loans or certain types of car loans can also fall into this category. This kind of debt doesn't build wealth, it drains it. For our discussion today, we're focusing on strategies to tackle that wealth-draining, high-interest debt, as it's often the biggest obstacle to financial progress. Once you've used your spending plan to identify how much extra money you can put toward your debt each month, even if it's a small amount, the question becomes, which debt do you pay off first? There are two very popular and effective strategies that people use to answer this question. Let's explore both, so you can understand the philosophy behind each one. The first is called the debt snowball method. Imagine a small snowball at the top of a hill. As you roll it, it picks up more snow, getting bigger and faster as it goes. The debt snowball method works in a similar way, using psychological momentum. Here's how you would approach it. First, you list all of your debts, from the smallest balance to the largest, regardless of the interest rates. You continue to make the minimum required payment on every single debt. Then you take every extra dollar you have and throw it at the debt with the smallest balance. You attack it with everything you've got until it's completely paid off. Once that smallest debt is gone, you feel an incredible sense of victory. You've won. You then take the full amount you were paying on that debt, the minimum payment plus all the extra, and roll it onto the next smallest debt on your list. Now you're making the minimum payment plus a much larger payment on this new target. You repeat the process, and with each debt you eliminate, your snowball of payment gets bigger and bigger, allowing you to knock out the larger debts much faster than you thought possible. The power of the debt snowball is in its motivation. Those quick wins at the beginning can provide the encouragement you need to stay committed for the long haul. The second popular strategy is known as the debt avalanche method. This method focuses purely on the mathematics of saving money. Here's the approach. You start by listing your debts, but this time, you order them from the highest interest rate, or APR, down to the lowest, regardless of the balance. Again, you make the minimum payments on everything, but you channel all of your extra money to attack the debt with the highest interest rate. This is because the highest interest rate debt is costing you the most money every single month. By eliminating it first, you save the maximum amount of money in interest payments over the life of your loans. Once that high-interest debt is paid off, you take the entire payment amount and avalanche it onto the debt with the next highest interest rate. You continue this process until you are debt-free. The debt avalanche method is, mathematically speaking, the most efficient way to pay off debt, and will save you the most money. However, it may take longer to feel that first sense of accomplishment if your highest interest debt also has a large balance. So which strategy is better? The truth is, the best strategy is the one you will actually stick with. Some people are motivated by the math and want to save every possible dollar. They might prefer the avalanche. Others need those motivating quick wins to stay in the fight. They might prefer the snowball. The most important step is to choose a strategy, create a plan, and be consistent. While you're executing your plan, it's critical to stop adding to the problem. This means committing to not taking on any new high-interest debt while you're in the process of paying it off. Your spending plan from Chapter 2 is your best defense here. By creating a clear, intentional plan to manage and eliminate your high-interest debt, you are not just paying off bills. You are buying back your future. You are freeing up your single most powerful wealth-building tool, your income. Now that we have a plan to manage what we owe, our next chapter will focus on building our financial foundation for the future. We'll talk about creating a safety net to protect you from life's unexpected turns. The emergency fund. I will see you in Chapter 4. Hello and welcome back. So far on our journey, we have learned how to create a conscious spending plan to direct our money with purpose, and we've explored powerful strategies to begin breaking the chains of high-interest debt. These are incredible steps toward taking control. But what happens when life throws you a curveball? A flat tire on the way to work, a sudden trip to the dentist, or a leaky roof after a storm? Without a plan, these unexpected events can send us right back into debt, undoing all our hard work. Today, we're building our shield. We're going to talk about constructing the most critical piece of your financial foundation, the emergency fund. Before we do, let's reiterate our essential guiding principle. The information shared here is for educational and informational purposes only, and is not financial, legal, or investment advice. An emergency fund is a cornerstone of personal finance. but the specific amount and strategy for you should be discussed with a licensed and qualified financial professional who understands your complete financial picture. Our mission is to help you understand the what and the why so you can have that conversation with confidence. So, what exactly is an emergency fund? Put simply, it is a stash of money set aside for one purpose and one purpose only: to cover large, unexpected, and necessary expenses. It is your personal financial safety net. It's the buffer between you and the chaos of life. Its job is not to make you rich. It's not an investment. Its job is to protect you and your long-term financial goals from being derailed by short-term crises. Think of it as a financial shock absorber. When you hit a pothole on the road of life, the emergency fund softens the blow, allowing you to keep moving forward without crippling your progress. The lack of an emergency fund is why so many people get trapped in a cycle of debt. An unexpected car repair of $800 gets put on a high-interest credit card because there's no cash to cover it. That $800 problem can quickly become a $1,000 problem as interest piles on, making it even harder to get ahead the next month. An emergency fund breaks this cycle. It turns a potential crisis into a mere inconvenience. This leads to the most common question: how much do I actually need to save? This is a deeply personal question, but a widely accepted guideline among financial experts is to have 3 to 6 months worth of essential living expenses set aside. Now let's break down that phrase, because it's very important. Essential living expenses does not mean 3 to 6 months of your income. It means the absolute bare bones amount of money you would need to survive each month if you lost your primary source of income. To calculate this, you would add up your must-pay bills, your rent or mortgage, your essential utilities like water and electricity, your minimum transportation costs to get to interviews or work, your basic grocery bill, and your required minimum debt and insurance payments. You would leave out discretionary spending like entertainment, dining out, and subscriptions. The sum of these essential costs is your 1-month survival number. You then multiply that number by 3 to 6 to find your target range. Someone in a stable, dual-income household might feel secure on the lower end, closer to 3 months. On the other hand, someone who is self-employed, works on commission, or is the sole provider for their family may want to aim for the higher end of that range, perhaps 6 months or even more for added peace of mind. I know that number can sound intimidating. If you're just starting out, saving thousands of dollars can feel like an impossible mountain to climb. Please do not let that discourage you. You don't have to get there overnight. The most important thing is to simply start. Many people find success by first focusing on building a starter emergency fund. This is a smaller, more achievable goal like $1,000. $1,000 is enough to cover a vast majority of common emergencies: a new set of tires, a dental filling, a plumbing issue. Reaching this initial goal provides a powerful psychological boost and a tangible layer of security that you can build upon over time. Okay, so you're ready to start saving. Where should you keep this money? The location of your emergency fund is just as important as the amount. It needs to have 3 key characteristics. First, it must be safe. This money cannot be exposed to market risk. That means the stock market is not the place for your emergency fund. You need to know that 100% of it will be there when you need it. In the United States, this means looking for accounts that are FDIC or NCUA insured, which protects your money up to the legal limit. Second, it must be liquid. This is a financial term that simply means easy to access. You should be able to get to your money within a day or 2 without paying any penalties or taxes. And third, it should be separate. It is crucial to keep your emergency fund in a different account from your everyday checking account. This creates a psychological barrier. If the money is mixed in with your daily spending money, it's far too tempting to use it for non-emergencies. Keeping it separate makes it a deliberate, conscious choice to use it. A very popular option that meets all 3 of these criteria is a high-yield savings account. These are typically offered by online banks, are FDIC insured, are easily accessible, and as the name suggests, they usually offer a significantly higher interest rate than a traditional savings account. This helps your money grow slightly and better combat the effects of inflation while it waits to protect you. Finally, how do you define a true emergency? A good test is to ask yourself 3 questions. Is this expense unexpected? Is it necessary? And is it urgent? A job loss or a medical bill is a clear yes. A 50% off sale on a new television or a last-minute flight deal for a vacation is a no. This fund is your shield, so protect it fiercely for the moments you truly need it. Building your emergency fund is one of the most powerful acts of self-care you can perform. It is a gift to your future self, providing not just money, but invaluable peace of mind. Now, with our foundation firmly in place, we can begin to look up and ahead. In our next chapter, we'll shift our focus from defense to offense, exploring how to save for major life goals and introducing the world of investing. I'll see you then. Hello and welcome back. In our journey so far, we have built a powerful financial defense. We have a spending plan to command our cash flow, a strategy to eliminate debt, and a plan for our emergency fund to shield us from unexpected shocks. We've created stability. Now it's time to shift our mindset from defense to offense. It's time to start thinking about how to build long-term wealth. Today, we'll open the door to one of the most powerful concepts in personal finance, making your money work for you through investing. Let me be exceptionally clear before we proceed. This chapter is an introduction to the concepts of investing. It is for educational and informational purposes only, and is absolutely not investment advice. Investing involves risk, including the potential loss of the principal amount you invest. Any investment decisions you consider should be made only after thorough research and consultation with a licensed and qualified financial advisor or fiduciary, who is legally obligated to act in your best interest. Our goal today is to demystify the language of investing and introduce you to the foundational ideas, so you are better prepared for those future conversations. First, let's distinguish between two words we often use interchangeably: saving and investing. They are, in fact, very different. Saving is the act of putting money aside in a safe, secure, and easily accessible place for short-term goals. Your emergency fund is a perfect example of saving. You also save for things like a down payment on a car you plan to buy next year, or a vacation you're taking in 10 months. The primary goal of saving is capital preservation, making sure the money is there when you need it. Investing, on the other hand, is the act of using your money to purchase assets with the expectation that they will generate a positive return or grow in value over a long period of time. This could involve buying stocks, bonds, mutual funds, or real estate, among other things. The primary goal of investing is growth. But with the potential for greater growth comes greater risk. The value of investments can go up, but it can also go down. This is the fundamental trade-off. Think of it this way. Saving is like parking your money in a highly secure, guarded garage. It will be safe and sound. Investing is like putting your money into a vehicle designed for a long-distance journey. That vehicle has the potential to take you much farther than you could walk on your own. But the journey will inevitably have bumps, detours, and maybe even some breakdowns along the way. So if investing has risks, why do it at all? The answer lies in overcoming a powerful, invisible force that eats away at your money's value: inflation. Inflation is the rate at which the general cost of goods and services rises, and subsequently, the purchasing power of currency falls. The $5 that bought you a coffee and a pastry 10 years ago might only buy you the coffee today. If you just leave your money sitting in a low-interest savings account, it is slowly losing its ability to buy things over time. Investing gives your money the potential to grow faster than the rate of inflation, thereby increasing your future purchasing power. The engine that drives this growth is a concept that has been called the eighth wonder of the world: compound growth. This is the idea of earning returns not just on your original investment, but on the accumulated returns as well. Let's use a simplified, hypothetical illustration. Imagine you invest $1,000, and it earns a hypothetical 8% return in 1 year. You now have $1,080. The next year, if you earn another 8%, you're earning it on the full $1,080, not just your original $1,000. This process of your earnings generating their own earnings starts slowly, and then begins to accelerate dramatically over time. This is why starting to invest early, even with small amounts, can be so powerful over the long run. Time is the most critical ingredient for compounding to work its magic. Two other key concepts you must understand before even thinking about investing are your time horizon and your risk tolerance. Your time horizon is simply how long it will be until you need the money. Are you saving for a house in 3 years, or for retirement in 30 years?
Disclaimer: the information presented is for informational purposes only, and is not professional financial, investment, or tax advice. All investments involve risk, and may result in partial or total loss. You should always conduct your own research, and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The longer your time horizon, the more time you have to ride out the market's inevitable ups and downs. This is why financial professionals will often say that money you need in the next 5 years should generally not be invested in assets like the stock market. Risk tolerance is about your personal and emotional ability to handle those ups and downs. Does the thought of your account balance dropping by 15% make you want to panic and sell everything? Or do you understand it as a normal part of the long-term journey? There is no right or wrong answer here. It's a reflection of your personality and financial situation. Understanding your own risk tolerance is a critical first step in any investment planning. In the United States, there are specific types of accounts designed to help people invest for long-term goals like retirement, often with special tax advantages. You will hear these terms, so it's good to know what they are at a high level. A 401k or a 403b is an employer-sponsored retirement plan. You contribute a portion of your paycheck, and sometimes, your employer will offer a match, where they contribute money on your behalf as well. This employer match is one of the most powerful tools for wealth creation available. An individual retirement arrangement, or IRA, is a retirement account you can open on your own, separate from any employer. There are different types, like traditional and Roth IRAs, which have different rules about how your contributions and withdrawals are taxed. Again, these are just the names of the accounts, the containers that hold your investments. What you invest in inside of them is a separate and much more complex decision. Our goal today was to introduce these core ideas. Investing is the path from financial stability to financial growth and independence. It is a long-term journey, not a get-rich-quick scheme. Now that we understand the framework for building wealth, it's time to turn our attention to a 3-digit number that profoundly impacts our financial lives in the United States: our credit score. In the next chapter, we will demystify what a credit score is, how it's calculated, and why it's a critical tool to manage. I'll see you there. Hello, and welcome back to our journey toward financial empowerment. We've established our financial foundation with a spending plan, a debt reduction strategy, an emergency fund, and we've introduced the long-term concepts of saving and investing. Today, we're going to decode a 3-digit number that has a profound, often invisible, impact on nearly every aspect of our financial lives in the United States. We're talking about your credit score. As we dive into this important topic, please remember that this chapter is for educational and informational purposes only. The information provided is general in nature and does not constitute financial or legal advice. Your credit situation is unique, and for personalized guidance, it is always best to consult with a qualified financial counselor or professional. Our goal is to lift the curtain on credit scores so you can understand and manage this powerful tool. So, what exactly is a credit score? A credit score is a number, typically ranging from 300 to 850, that is designed to represent your creditworthiness. In simpler terms, it's a snapshot that tells lenders how likely you are to pay back borrowed money. The higher the score, the more confident a lender can be that you'll handle your financial obligations responsibly. Think of it like a financial report card. It doesn't measure your income or how much money you have in the bank. It simply scores you based on your history of borrowing and repaying money. This information is collected by 3 major credit bureaus in the U.S.: Equifax, Experian, and TransUnion. These bureaus then use scoring models, with the most well-known being the FICO score, to calculate your number based on the data in your credit report. To truly understand your score, you need to know what goes into it. While the exact formulas are proprietary, FICO has been very transparent about the 5 main categories of information that drive your score and the approximate weight of each. The first and most important ingredient, making up about 35% of your score, is your payment history. This is the heavyweight champion of all the factors. The question it answers is simple: do you pay your bills on time? A consistent history of on-time payments will build a strong score. Conversely, late payments, accounts sent to collections, or major events like a bankruptcy can have a significant and long-lasting negative impact. The second most important factor, at around 30% of your score, is amounts owed. This isn't just about how much debt you have in total, but more specifically, how much of your available credit you are using. This is known as your credit utilization ratio. For example, if you have one credit card with a $10,000 limit and a $2,000 balance, your utilization is 20%. While there's no magic number, most experts suggest that keeping your overall utilization below 30% is a healthy practice. High utilization can signal to lenders that you may be overextended and reliant on credit. Third on the list, at about 15%, is the length of your credit history. This looks at the average age of all your credit accounts. A longer credit history generally demonstrates more experience managing credit, which can positively influence your score. This is why it can be beneficial to keep old and used credit card accounts open, as long as they aren't costing you an annual fee. The fourth factor is your credit mix, which accounts for about 10% of your score. Lenders like to see that you can responsibly manage different types of credit. A healthy mix might include what's known as revolving credit, like credit cards, and installment loans, like a car loan or a mortgage, where you make the same payment every month for a set period. Finally, the last 10% is attributed to new credit. This factor looks at how recently and how often you've applied for new credit. If you apply for several new credit cards or loans in a short period, it can be a red flag for lenders, suggesting you may be in financial trouble. Each of these applications can result in a hard inquiry on your report, which can temporarily dip your score by a few points. So now that we know what goes into the score, why does it matter so much? Your credit score is one of the single most impactful numbers in your financial life. It can be the gatekeeper to your goals. A higher score makes you a more attractive borrower, which often translates to a higher likelihood of approval for loans and, most importantly, lower interest rates. Let's use a clear example. Imagine two people, Alex and Ben, are both buying the exact same $30,000 car. Alex has a great credit score of 780 and qualifies for a 5% interest rate on a 5-year loan. Ben has a poor credit score of 610 and can only get a loan with a 12% interest rate. Over the life of the loan, Ben will end up paying thousands of dollars more in interest than Alex for the identical car. That's money that could have gone towards savings, investing, or other goals. Your credit score has a direct, real-dollar impact on your wallet. Beyond just loans, your credit is often checked when you apply to rent an apartment, set up utility services for your home, and in some states and industries, it can even be a factor in getting a job. So how do you stay on top of this? It's crucial to distinguish between your credit score and your credit report. The report is the detailed document with your entire history. The score is the grade based on that report. You have a legal right to see what's on your report. In the US, you are entitled to one free credit report from each of the 3 major bureaus every year through the official, federally authorized website, annualcreditreport.com. It is a fantastic habit to pull these reports annually to check for any errors or fraudulent activity, which can and do happen. Your credit score is not a reflection of you as a person or a measure of your self-worth. It is simply a tool. And now that you understand how it works, you have the power to manage it. Building good credit is a marathon, not a sprint, achieved through the simple, consistent habits of paying your bills on time and keeping your balances low. Now that we understand the tools of saving, investing, and credit, we can start to see how they come together to help us achieve some of the biggest financial milestones in life. In our next chapter, we'll explore the process of planning for major life purchases, from a car to your very first home. I'll see you there. Hello and welcome back. Up to this point in our series, we have been building a powerful financial toolkit. We've learned to manage our cash flow, strategize against debt, build a safety net, understand our credit, and conceptualize long-term investing. Today is where the rubber meets the road. We're going to discuss how to use all of these skills to plan for some of the biggest purchases you'll ever make: a car and a home. Before we explore these exciting milestones, we must begin with our standard, crucial reminder. This chapter provides a general educational overview of the financial planning process for major purchases. It is not financial advice, nor is it real estate or auto lending advice. The decision to buy, how much to spend, and the type of financing you choose are deeply personal and should be made in consultation with qualified, licensed professionals, such as a financial advisor, mortgage lender, or real estate agent. Our goal is to make you an informed and confident consumer. Let's start with a purchase that is a rite of passage for many Americans: buying a car. A car is more than just transportation, it's often a symbol of freedom. But if not planned for carefully, it can become a major financial burden. The biggest mistake people make is focusing only on the monthly payment. To make a smart decision, you must consider the total cost of ownership. This includes not just the car payment but also the ongoing expenses that come with it. Auto insurance, which can vary wildly depending on the car, fuel costs, regular maintenance like oil changes and tire rotations, and potential for unexpected repairs. All of these costs are part of your transportation budget. A popular framework that can help guide your decision-making is a guideline known as the April 20th, 10 rule. Again, this is not a rigid command, but a helpful set of guardrails to consider. The 20 stands for a 20% down payment. Paying a significant amount upfront reduces the amount you need to borrow, which can help you secure a lower interest rate and lowers your monthly payment. It also helps prevent you from becoming upside down on your loan, which is when you owe more than the car is actually worth. The 4 stands for a maximum loan term of 4 years. While a 5, 6, or even 7-year loan will have a lower monthly payment, you'll end up paying significantly more in interest over time. A shorter loan term ensures you pay off the car faster and build equity in your asset. And finally, the 10 suggests that your total monthly car expenses, that's the payment, insurance, and fuel combined, should not exceed 10% of your gross monthly income. This helps ensure that your vehicle doesn't crowd out other important financial goals, like saving and investing. One of the most powerful moves you can make before you even step into a dealership is to get pre-approved for a loan from your own bank or a local credit union. Walking in with a pre-approval letter in hand effectively turns you into a cash buyer in the eyes of the dealer. It separates the negotiation for the price of the car from the negotiation for the financing, giving you much more leverage and protecting you from potentially unfavorable dealership financing terms. Now let's talk about the big one: planning to buy a home. For many, this is the cornerstone of the American dream. It can be a powerful way to build long-term wealth, but it's also the largest financial commitment most people will ever make. Let's break down the key financial components. First is the down payment. This is the portion of the home's purchase price that you pay up front. You've likely heard the common advice to save for a 20% down payment. The reason for this specific number is to avoid something called private mortgage insurance, or PMI. PMI is an extra fee added to your monthly mortgage payment that protects the lender in case you default on the loan. It doesn't benefit you at all. By putting 20% down, you are generally not required to pay PMI. However, it's important to know that many loan types, such as FHA loans, allow for much smaller down payments, but they will include mortgage insurance. Next are the closing costs. This is an often underestimated expense. These are the fees you pay to finalize the real estate transaction. They can include things like the loan origination fee, appraisal fee, title insurance, and attorney fees. A safe estimate is to budget for 2% to 5% of the home's purchase price for closing costs, in addition to your down payment. It's also critical to look beyond the initial purchase and understand the true ongoing costs of homeownership. Your monthly payment is often referred to by the acronym PITI. That stands for principal, the amount that goes toward paying down your loan balance; interest, the cost of borrowing the money; taxes, your property taxes; and insurance, your homeowner's insurance. Beyond PITI, you are also responsible for all maintenance and repairs, from a leaky faucet to a new roof, plus any potential homeowners association, or HOA fees. Preparing to buy a home is about getting your entire financial house in order. Lenders will closely examine your credit score, which we discussed in the last chapter. They will look at your debt-to-income ratio, or DTI, which compares your total monthly debt payments to your gross monthly income. And they will want to see a stable history of employment and income. Achieving these major goals is rarely a solo mission. You'll want to assemble a team of qualified professionals, including a trusted real estate agent to represent your interests, a mortgage lender or broker to handle the financing, and a home inspector to ensure the property is sound. Planning for these major purchases is the ultimate test of your financial literacy skills. It's about being proactive, doing your research, and understanding that the price tag is only the beginning of the story. By doing so, you can turn these dreams into realities, with confidence and control. Now that we know how to plan for acquiring major assets, it's equally important to know how to protect them, and ourselves, from risk. In our next chapter, we'll demystify the essential world of insurance. I'll see you there. Hello and welcome back. Over the last several chapters, we have focused on building a strong financial life. We've created plans to manage our money, get out of debt, save for the future, and acquire major assets. But all of this hard work could be undone in an instant by a single, unexpected event. An accident, a health crisis, or a natural disaster can be financially devastating without a proper defense. Today we're talking about that defense. We're going to demystify the world of insurance. It is absolutely critical to state at the outset that this chapter is for general educational purposes only. It is an introduction to insurance concepts, not a recommendation or solicitation to buy any specific insurance product. Insurance is a highly regulated industry, and your personal needs are unique. To get advice on specific products or coverage amounts, you must speak with a qualified and licensed insurance professional who can assess your individual situation. Our goal today is to provide you with a foundational understanding of what insurance is and what it does. At its core, the concept of insurance is quite simple. It's a tool for managing risk. You pay a regular, predictable amount of money, called a premium, to an insurance company. In exchange for your premium, the company agrees to take on the financial risk of a specific, unpredictable, and potentially catastrophic event. If that event occurs, the insurance company pays for the damages up to the limits of your policy. Insurance isn't designed to make you rich. It's designed to prevent a major loss from making you poor. It is the financial armor that protects the assets you've worked so hard to build. Let's walk through the major types of insurance that form the pillars of a solid financial plan in the United States. First, and arguably most important, is health insurance. In the US, the cost of medical care can be extraordinarily high. A single hospital stay or major procedure can cost tens or even hundreds of thousands of dollars. Health insurance is designed to make these costs manageable. When looking at health insurance, you'll encounter a few key terms. The deductible is the amount you must pay for health care out of pocket before your insurance plan starts to pay. A copay is a fixed amount you pay for a covered service, like a doctor's visit. And the out-of-pocket maximum is the absolute most you would have to pay for covered services in a single year, providing a critical cap on your financial risk. Next is auto insurance, which is a legal requirement to drive in most states. It primarily protects you from the massive financial liability that can result from a car accident. The core of any policy is liability coverage, which pays for bodily injury and property damage that you cause to other people. Collision coverage pays to repair or replace your car if it's damaged in an accident. And comprehensive coverage protects your car from non-accident related events, like theft, vandalism, or storm damage. Similar to protecting your car, you need to protect your home. Homeowners and renters insurance is often misunderstood, especially by renters. For a homeowner, it covers damage to the physical structure of your house, as well as your personal belongings inside. For a renter, it covers all of your personal property, your furniture, electronics, and clothes. Crucially, both types of policies also provide liability protection. This means if someone is accidentally injured in your home or apartment, the insurance can cover their medical bills and protect you from a potential lawsuit. Renters insurance is incredibly affordable and absolutely essential. Now let's discuss a topic that can be difficult to think about, but is vital for anyone with dependents: life insurance. The purpose of life insurance is to provide a tax-free cash payment to your chosen beneficiaries if you pass away. It answers one simple question: would anyone I care about suffer financially if my income were to disappear? If you have a spouse, children, or anyone else who relies on you financially, life insurance is a tool to consider. There are two basic categories. Term life insurance is pure protection. You buy a policy that covers you for a specific term, like 20 or 30 years. If you pass away during that term, your beneficiaries receive the payout. It is typically very straightforward and affordable. Whole life insurance, a form of permanent insurance, provides lifelong coverage and also includes a savings component called cash value that can grow over time. These policies are generally more complex and significantly more expensive than term policies. Finally, let's touch on one of the most overlooked but important types of insurance: disability insurance. Many people insure their car and their home, but they forget to insure their single greatest asset: their ability to earn an income. Disability insurance is essentially paycheck insurance. If a serious illness or injury prevents you from working for an extended period, this insurance will replace a portion of your lost income, allowing you to continue paying your bills and funding your financial plan. Navigating the world of insurance can feel overwhelming, but it doesn't have to be. The key is to view it as an integral part of your financial strategy. It's wise to periodically review your coverage to ensure it still aligns with your life. Major life events like getting married, buying a home, or having a child are perfect triggers to reevaluate your insurance needs, preferably with the help of a licensed professional. Ultimately, insurance buys you more than just financial protection. It buys you peace of mind. It allows you to live your life and pursue your goals, knowing that you have a powerful safety net ready to catch you if the unexpected happens. Now that we understand how to protect our financial lives from external risks, it's time to tackle another area that can cause a lot of confusion: our obligations to the government. In our next chapter, we will demystify the basics of the US tax system. I'll see you there. Hello and welcome back. There's an old saying that nothing in life is certain except death and taxes. For millions of Americans, tax season brings with it a wave of confusion, anxiety, and stress. The forms can seem complicated, the language can feel foreign, and the stakes feel high. Today, our goal is to strip away that fear by providing a basic introduction to the United States tax system. We're going to learn the language so you can navigate the numbers with more confidence. Let me begin with the most important disclaimer of this entire series. This chapter is for general educational and informational purposes only. It is not tax advice. Tax laws in the United States are incredibly complex, they change frequently, and they are subject to interpretation. Your personal tax situation is unique. You should always consult with a qualified tax professional. such as a certified public accountant, CPA, or an enrolled agent, or use reputable tax preparation software to handle your specific tax needs. Our mission today is simply to demystify the core concepts. First, the big picture. Why do we pay taxes? In short, taxes are how we fund our society. The money collected by federal, state, and local governments pays for public services like roads and bridges, public schools, national defense, and social programs. While we pay many kinds of taxes, like sales tax on goods we buy and property tax on homes we own, our focus today will be on the one that affects most of us directly: federal income tax. To understand your taxes, you need to understand the vocabulary. Let's walk through the key terms in the order you might encounter them when preparing a tax return. It all starts with your gross income. This is simply all the money you earned in a year from all sources before anything is taken out. This includes your salary from a job, any income from a side business, tips, and even investment gains. From your gross income, certain specific deductions are subtracted to arrive at a very important number called your adjusted gross income, or AGI. Your AGI is a key line on your tax return that is used to determine your eligibility for certain tax credits and deductions. Next, you lower your income even further by using either the standard deduction or itemized deductions. The standard deduction is a fixed dollar amount, determined by the government each year, that you can subtract from your AGI, no questions asked. The amount depends on your filing status, whether you're single, married, etc. Most taxpayers use the standard deduction because of its simplicity. Itemized deductions, on the other hand, are a list of specific eligible expenses, such as certain state and local taxes, mortgage interest, and charitable contributions, that you can tally up and subtract instead. You would choose to itemize only if your total itemized deductions are greater than the standard deduction for your filing status. After you subtract either the standard or itemized deductions from your AGI, you are left with your taxable income. This is the final amount of your income that is actually subject to tax. Now we come to one of the most important distinctions in the tax world: tax deductions versus tax credits. A tax deduction reduces your taxable income. So, a $1,000 deduction might save you $120 or $220 in tax, depending on your tax bracket. A tax credit, however, is a dollar-for-dollar reduction of your actual tax bill. A $1,000 tax credit reduces your tax bill by $1,000. This makes tax credits significantly more valuable than tax deductions. So how is your tax bill calculated from your taxable income? The U.S. uses a progressive tax system, which means people with higher taxable incomes are subject to higher tax rates. This system is organized into tax brackets. This is where a major misconception often occurs. People sometimes worry that if they earn more money and move into a higher tax bracket, all their income will be taxed at that higher rate, potentially making them take home less money. This is not how it works. Only the portion of your income that falls within a specific bracket is taxed at that bracket's rate. For example, and these are just simple hypothetical numbers. Let's say the first tax bracket is 10% on income up to $10,000. The second bracket is 12% on income from $10,001 to $40,000. If your taxable income is $30,000, you don't pay 12% on the whole amount. You would pay 10% on the first $10,000, and 12% only on the remaining $20,000 that falls into the second bracket. Everyone pays the same rate on the same income levels. You interact with the tax system throughout the year, primarily through the Form W, for you fill out with your employer. This form tells your employer how much tax to withhold from each of your paychecks. The goal is to withhold an amount that is as close as possible to what you'll actually owe at the end of the year. The final accounting is done on your tax return, most commonly filed using Form 1040. While you don't need to be a tax expert, understanding this basic flow, from gross income to taxable income, and knowing the difference between a deduction and a credit, can transform taxes from a source of fear into a manageable part of your financial life. Now that we've covered how we handle our obligations to the government, it's time to focus on our obligations to our future selves. In our next chapter, we will begin to explore the fundamentals of planning for the longest vacation of your life, retirement. I'll see you there. Hello and welcome back. Throughout this series, we have been methodically building the components of a healthy financial life. We've learned to manage our daily finances, protect ourselves from risk, and plan for major goals. Today, we turn our attention to the ultimate long-term goal. We're going to discuss planning for the longest and most well-deserved vacation of your life, retirement. Before we delve into this crucial topic, it is essential to start with our disclaimer. This chapter provides a general, high-level overview of retirement planning concepts, and is for educational purposes only. It is not financial, investment, or tax advice. Planning for retirement is a complex, long-term endeavor that is deeply personal. For advice tailored to your specific goals and circumstances, you must consult with a qualified financial professional, preferably a fiduciary, who is required to act in your best interest. First, let's redefine what retirement really means in the 21st century. For generations past, retirement was often an age, 65, when you stopped working and lived off a company pension. Today, that world has largely vanished. For most of us, the responsibility to fund our retirement rests squarely on our own shoulders. It's helpful to stop thinking of retirement as an age and start thinking of it as a financial state. Retirement is the point at which you have accumulated enough assets that can generate enough income to cover your lifestyle expenses, without you having to work for money. It is the point where work becomes a choice, not a necessity. It is the ultimate financial freedom. This naturally leads to the biggest question everyone has. How much money do I need to save? While the true answer is unique to your desired lifestyle, there are some helpful guidelines that financial professionals use as a starting point for discussion. For how much to save on an ongoing basis. A common benchmark is to aim to save at least 15% of your pre-tax income for retirement every year throughout your career. That number might sound high, especially when you're starting out, but it's a target to work towards. The important thing is to begin, even with a smaller percentage, and increase it over time. For how much you need in total, one popular model to help you conceptualize a target is the 4% rule. This is a guideline that suggests you can likely withdraw 4% of your starting retirement portfolio in your first year of retirement, and then adjust that amount for inflation each subsequent year, with a high probability of your money lasting for at least 30 years. So to get a rough estimate of a target nest egg, you could multiply your desired annual retirement income by 25. For example, if you think you'll need $50,000 a year in retirement, this guideline would suggest a target portfolio of $1.25 million. This is a simplified model, not a guarantee, but it provides a tangible goal to aim for. So, where do you put this money? We touched on this in our investing chapter, but let's revisit the primary tools or accounts designed for this purpose. The most common is the 401k, or its nonprofit equivalent, the 403b. This is the retirement plan offered by your employer. Its single most powerful feature is often the employer match. If your employer offers to match your contributions up to, say, 3% of your salary, you should do everything in your power to contribute at least that 3%. Not doing so is like turning down a 100% return on your money. It's a part of your compensation package you'd be leaving on the table. Outside of work, you have the individual retirement arrangement, or IRA. The two main types are the traditional IRA and the Roth IRA, and their primary difference is how they are treated for tax purposes. With a traditional IRA, your contributions may be tax-deductible now. This means you get a tax break in the present. Your money grows tax-deferred, and then you pay ordinary income tax on the withdrawals you make in retirement. Think of it as pay the tax later. With a Roth IRA, your contributions are made with after-tax dollars, meaning you get no immediate tax break. But your money grows completely tax-free, and all of your qualified withdrawals in retirement are also completely tax-free. Think of it as pay the tax now. Which one is better? It's not a simple answer. The decision often hinges on whether you believe your income tax rate will be higher today, while you are working, or later in retirement. It's a strategic choice and a perfect topic to discuss with a financial or tax professional. No matter which account you use, the most powerful ingredient in your retirement plan is not money, it's time. The power of compound growth is truly staggering over long periods. Let's imagine two people. Anna starts investing $400 a month for retirement at age 25. Ben gets a late start and begins investing the exact same $400 a month at age 35. They both earn the same hypothetical return and stop at age 65. Because Anna's money had an extra 10 years to grow and compound, her final nest egg could be hundreds of thousands of dollars larger than Ben's, even though his total contributions were only $48,000 less than hers.
Disclaimer. The information presented is for informational purposes only, and is not professional financial, investment, or tax advice. All investments involve risk, and may result in partial or total loss. You should always conduct your own research, and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
This illustrates that starting early is the closest thing we have to a superpower in finance. planning for a goal that is decades away can feel abstract and overwhelming. But it's not achieved in one giant leap. It's achieved one paycheck at a time, one contribution at a time, year after year. The key is to create a plan, make your savings automatic, and let time do the heavy lifting. Planning for your own retirement is a critical long-term goal, but your financial life is rarely a solo journey. In our next chapter, we'll discuss the important, and sometimes challenging, topic of money and relationships, from managing finances as a couple to teaching your children the basics of financial literacy. I'll see you there. Hello and welcome back. For the past 10 chapters, we have focused on the nuts and bolts of personal finance, the strategies, the tools, and the knowledge you need to build a strong financial foundation for yourself. But finance is rarely a solo journey. For most of us, our financial lives are deeply intertwined with the people we love most, our partners and our children. Money is consistently cited as one of the top sources of stress and conflict in relationships. Today, we're going to talk about how to turn it from a source of division into a tool for teamwork and a legacy of empowerment. Before we begin, it's important to clarify our purpose. This chapter explores common communication strategies and general concepts related to family finances. It is for educational purposes only, and is not a substitute for professional guidance from a licensed marriage and family therapist, nor is it financial advice. Every family is unique, and the right approach is the one that works for you. Let's start with what is often the most complex financial partnership: managing money with a spouse or significant other. The absolute bedrock of a successful financial partnership is not a specific type of bank account or budget. It's open, honest, and ongoing communication. The first step is to understand that you and your partner likely have very different money stories. The way you view money, whether you tend to be a saver or a spender, whether money feels like a source of security or stress, was largely shaped by your experiences growing up. Take the time to have a non-judgmental conversation about your financial upbringings. Understanding where your partner is coming from can build a powerful foundation of empathy and help you navigate disagreements more effectively. Once you have that foundation, the next step is to create a shared vision. What do you, as a team, want to accomplish? Do you want to be debt-free? Buy a house? Travel the world? Retire early? When you have shared goals, your day-to-day financial decisions are no longer about restriction. They are about consciously moving toward the future you are building together. With communication and shared goals in place, you can then decide on the practicalities of how to merge your financial lives. There is no single right way to do this. Let's explore 3 common models that couples use. The first is the yours, mine, and ours approach. In this system, each partner maintains their own separate checking account for personal income and discretionary spending. They then both contribute an agreed-upon amount to a third, joint account. This joint account is used to pay for all shared expenses: the mortgage or rent, utilities, groceries, and contributions to shared goals. This model can offer a great balance of autonomy and teamwork. The second model is the all-in-one pot approach. Here, all income from both partners is deposited into a single joint account. All bills, personal spending, and savings come from this one account. This system requires a very high level of trust and communication, but it promotes complete transparency and can reinforce the feeling of being a single financial unit. The third model is keeping completely separate accounts. In this system, partners do not merge their money at all. They decide on a fair way to split the bills, perhaps 50-50, or proportionally based on their incomes, and each person is responsible for paying their share from their own account. This approach maintains the most individual autonomy, but can sometimes make it more challenging to work towards large, long-term shared goals. None of these systems is inherently better than the others. The best system is the one that you and your partner can agree on, that feels fair to both of you, and that helps you achieve your shared goals. Now let's shift our focus to the next generation. Teaching our children about money is one of the greatest gifts we can give them. It prepares them for the real world and helps them build a life of stability and confidence. The key is to make the lessons age-appropriate. For young children, from ages 3 to 7, the concepts should be simple and visual. Use a clear jar instead of a piggy bank so they can physically see their money growing. When you use an ATM, explain that the money isn't free. It's coming from the money you earned at your job. In the grocery store, you can talk about why you're choosing one item over another based on its price. For elementary and middle schoolers, from ages 8 to 13, you can introduce more concrete concepts. This is a great time to start an allowance, which gives them the opportunity to manage their own money. A simple framework is the 3-jar system: spend, save, and give. This teaches them that money is a tool with multiple purposes from a young age. Help them set a goal for something they want to buy, which teaches them the invaluable lesson of delayed gratification. For teenagers, from ages 14 to 18, it's time to transition them to real-world financial tools. Help them open their first student checking and savings account with a debit card. When they get their first job, sit down with their first pay stub and explain gross pay, net pay, and all those deductions for taxes. This is also the time to introduce the concept of credit. You might consider adding them as an authorized user on your credit card. This allows them to practice using a card under your supervision, while building a positive credit history before they even turn 18. Financial conversations within a family aren't always easy, but they are essential. They are how we build a legacy of financial well-being and turn money from a taboo topic into a normal part of life. Now that we've discussed managing finances within our homes, it's helpful to understand the larger forces at play outside our doors. In our next chapter, we'll zoom out and look at the basics of the U.S. economy, explaining concepts like inflation and interest rates and how they directly affect your personal finances. I'll see you there. Hello and welcome back. For our entire series, we have been focused inward, on the critical steps you can take to manage your own financial world. We've built a budget, tackled debt, and made plans for our future. But our personal finances don't exist in a vacuum. They are constantly being influenced by the larger economic environment. You hear the terms all the time in the news: GDP, inflation, the federal. Today, we are going to zoom out and demystify these big-picture concepts, so you can understand how the U.S. economy directly shapes your personal wallet. Let's begin with our important reminder. This chapter provides a simplified, non-political overview of basic economic concepts for educational purposes. It is not financial, investment, or political advice. Economics is a vast and complex field, and our goal today is simply to equip you with a foundational understanding of the key forces at play. Let's start with the broadest measure of the economy's health: gross domestic product, or GDP. In simple terms, GDP is the total monetary value of all the finished goods and services produced within a country's borders in a specific time period. Think of it as the country's ultimate economic report card. When you hear that GDP is growing, it generally means the economy is in a period of expansion. Businesses are producing more, which often leads to job creation, higher wages, and more opportunities for workers. Conversely, when GDP is shrinking for an extended period, the technical definition of a recession is 2 consecutive quarters of negative GDP growth. It means the economy is in a period of contraction. Businesses may scale back, job losses can increase, and financial uncertainty can rise. Understanding GDP helps you understand the overall economic season we are in. Next is a concept we've touched on before, but it deserves a closer look: inflation. Inflation is the rate at which the general level of prices for goods and services rises, and as a result, the purchasing power of your money falls. The dollar you have in your pocket today will buy you less than it did last year. In the US, the most common measure of inflation is the Consumer Price Index, or CPI, which tracks the average price change over time of a basket of common goods and services, like food, gasoline, and housing. Inflation has a direct and powerful impact on your personal finances. It is a silent tax that erodes the value of money sitting in a low-interest savings account. This is the primary reason why long-term investing is so crucial. It gives your money the potential to grow faster than inflation, preserving and increasing your purchasing power over time. High inflation also means your day-to-day cost of living goes up, which you'll feel at the grocery store and the gas pump, making a conscious spending plan even more important. So who is responsible for managing inflation? This brings us to one of the most powerful financial institutions in the world: the U.S. Federal Reserve, often simply called the Federal. The Fed is the central bank of the United States. It has a dual mandate from Congress: to promote maximum employment and to maintain stable prices, which essentially means keeping inflation under control. The Fed's primary tool for managing the economy is its ability to influence interest rates. Specifically, it sets a target for the federal funds rate, which is the rate at which banks lend money to each other overnight. This decision creates a ripple effect throughout the entire economy. When the Fed raises interest rates, it's like gently tapping the brakes on the economy. They typically do this to combat high inflation. It becomes more expensive for businesses and consumers to borrow money. The direct impact on you is that the interest rates on your credit cards will likely go up. New car loans and mortgages will become more expensive. On the bright side, the interest rate you earn in a high-yield savings account may also rise. When the Fed lowers interest rates, it's like pressing the accelerator. This is usually done to stimulate a sluggish economy. Borrowing becomes cheaper, which encourages spending and investment. For you, this can mean an opportunity to refinance your mortgage to a lower rate, and it can make it cheaper to finance a major purchase. Finally, let's look at the unemployment rate. This is the percentage of the nation's labor force that is currently out of work, but is actively looking for a job. It is a critical indicator of the health of the job market. A low unemployment rate generally signals a strong economy where jobs are plentiful. This can give employees more leverage to negotiate for higher wages and better benefits. A high unemployment rate, on the other hand, signals economic distress and a much more competitive job market. You don't need a degree in economics to be financially successful, but understanding these 4 key pillars, GDP, inflation, interest rates, and unemployment, empowers you. It allows you to understand the context behind the financial news, and to anticipate how the broader economic climate might affect your personal financial decisions. It helps you move from being a passive passenger to an informed driver on your financial journey. Understanding the economic environment is key to long-term planning. Another critical and often overlooked aspect of a comprehensive financial plan is deciding how your assets will be managed and passed on according to your wishes. In our next chapter, we'll introduce the important topic of estate planning basics. I'll see you there. Hello and welcome back. Throughout our financial literacy journey, we have focused on building a successful life, managing our money, achieving our goals, and protecting our assets. Today, we're going to discuss a topic that many people find uncomfortable, but one that is a profound act of responsibility and love. We're going to talk about planning your legacy through the basics of estate planning. Let me begin with the most serious and direct disclaimer of this entire series. This chapter provides a high-level, general overview of estate planning concepts for educational purposes only. It is absolutely not legal advice. Estate planning laws are incredibly complex and vary significantly from state to state. You must consult with a qualified estate planning attorney in your state to create a legally valid plan tailored to your specific circumstances. Attempting to do this on your own without professional guidance can lead to devastating consequences for your loved ones. Our goal today is simply to introduce you to the vocabulary and purpose of estate planning. First, what is an estate? The term sounds grand, but it's very simple. Your estate is everything you own at the time of your death. It's your house, your car, your bank accounts, your investments, your retirement funds, your furniture, and your personal belongings. Everyone has an estate. Estate planning, therefore, is the process of creating a clear set of legal instructions for what you want to happen to your assets after you die, and what you want to happen if you become incapacitated and are unable to make decisions for yourself. Why is this so important? If you don't have a plan, the state you live in has one for you. This is called dying intestate. In that case, state laws and a court system will determine how your property is distributed and who will care for your minor children. This court process, known as probate, can be lengthy, expensive, and is a matter of public record. Worst of all, the outcome may be completely different from what you would have wanted. A proper estate plan puts you in control. Let's talk about the core documents that typically make up a basic estate plan. The most well-known document is the last will and testament, or simply your will. A will is a legal document that states your final wishes. In it, you name an executor, a person you trust to be in charge of carrying out your instructions. You detail who you want to inherit your property and in what amounts. Most importantly for parents, a will is the only place where you can name a legal guardian for your minor children. This alone is reason enough for every parent to have a will. Next, and critically important, are beneficiary designations. For many of your most valuable assets, like your 401k, your IRA, your life insurance policy, and other investment accounts, you filled out a form when you opened the account that asked you to name a beneficiary. This designation is a legally binding contract. The person named on that form will receive the asset upon your death, regardless of what your will says. This is a crucial point many people miss. It is absolutely vital that you review your beneficiary designations every few years, and especially after any major life event, like a marriage, divorce, or the birth of a child, to ensure they reflect your current wishes. An estate plan also protects you while you're still alive. A durable power of attorney for finances is a legal document where you appoint a trusted person, known as your agent, to manage your financial affairs if you become incapacitated and are unable to do so yourself. This person can pay your bills, manage your bank accounts, and handle your investments, ensuring your financial life continues to run smoothly. Similarly, an advance healthcare directive deals with your medical wishes. This is often a two-part document. The first part is a living will, where you can state your preferences for end-of-life medical care, such as your wishes regarding life support. The second part is a healthcare power of attorney, or healthcare proxy, where you appoint a trusted agent to make medical decisions on your behalf if you are unconscious or otherwise unable to communicate. You may have also heard of a trust. A trust is a slightly more advanced estate planning tool. It's a legal entity that you can create to hold assets for the benefit of your designated beneficiaries. A common type, a revocable living trust, is often used to hold title to major assets like a home. One of the primary benefits of using a trust is that assets held within it can typically pass to your heirs outside of the public probate court process, making the transfer faster, more private, and often less expensive. This is a complex topic, and an estate planning attorney can explain if a trust is right for your situation. Creating an estate plan is not a set-it-and-forget-it task. It is a set of living documents that should be reviewed and potentially updated every few years as your life, your assets, and the laws change. Thinking about these topics can be challenging, but having a plan in place is one of the kindest and most responsible things you can do for your family. You are replacing uncertainty with clarity, and potential chaos with a clear path forward during what will already be an incredibly difficult time for them. Planning for the future is the core of financial literacy. A big part of that future for many families is navigating the world of higher education. In our next chapter, we'll explore strategies for saving and paying for college, a major financial goal for many American families. I'll see you there. Hello and welcome back. In our journey together, we have discussed planning for many of life's major financial milestones. For millions of American families, one of the largest and most daunting of these is preparing for the cost of higher education. A college degree is often seen as a key to unlocking opportunity, but it comes with a staggering price tag that can lead to decades of debt if not planned for carefully. Today, our goal is to break down the complex world of paying for college into a clear, manageable strategy. As we begin, it is vital to state that this chapter provides a general overview of college funding concepts and is for educational purposes only. It is not financial, investment, or tax advice. The rules around savings plans and financial aid can be complex. For personalized guidance, please consult with a qualified financial advisor, especially one who specializes in college planning. For many, the sheer cost of college can feel so overwhelming that they don't know where to begin. The strategy is best understood as a multi-pronged approach that involves saving, seeking aid, and borrowing wisely. Let's start with the part you have the most control over: saving. When it comes to saving for college, your greatest asset, just like with retirement, is time. Starting early allows the power of compound growth to do much of the heavy lifting for you. The most popular and powerful tool designed specifically for this purpose in the United States is the 529 plan. A 529 plan is a tax-advantaged savings and investment account designed to encourage saving for future education costs. These plans are sponsored by individual states, but you can typically enroll in almost any state's plan, regardless of where you live. The reason 529 plans are so popular is because of their significant tax benefits. In many cases, the money you put in grows tax-deferred, and when you withdraw it for qualified education expenses, like tuition, fees, room, board, and books, those withdrawals are completely tax-free at the federal level, and often at the state level as well. Some states may even offer a state income tax deduction for your contributions. This tax treatment makes a 529 plan a far more powerful savings vehicle for education than a standard savings or brokerage account. But saving is only one piece of the puzzle. The next, and absolutely critical, piece is financial aid. The gateway to all federal financial aid, and most aid from states and colleges themselves, is one single form: the FAFSA, which stands for the Free Application for Federal Student Aid. This is, without a doubt, the most important document in the entire college funding process. A common myth is that you shouldn't bother filling out the FAFSA if your family's income is above a certain level. This is a mistake. Many colleges and universities, including private ones, use the data from the FAFSA to determine eligibility for their own institutional grants and scholarships, which may not be based solely on need. You should plan to fill out the FAFSA every year that your child is in college. The FAFSA is used to calculate your family's eligibility for three main types of aid. First, there are grants, like the federal Pell Grant. This is the best kind of aid, because it is gift money that does not need to be repaid. Second is work study, a program that provides funding for part-time jobs for students, allowing them to earn money to help pay for education expenses. And third are federal student loans, which is borrowed money that absolutely must be paid back with interest. This brings us to the third piece of the puzzle: borrowing wisely. For most families, some amount of borrowing is necessary. However, student loan debt can be a massive burden on a young adult's financial life for decades. It's crucial to approach it with extreme caution. It's important to understand the difference between federal and private student loans. Federal student loans are funded by the government. They typically have fixed interest rates and offer important borrower protections, such as income-driven repayment plans, deferment, and forbearance options if you face financial hardship. Private student loans are issued by banks and other financial institutions. They often have variable interest rates that can rise over time, and they typically offer far fewer protections and repayment flexibilities. As a rule, you should always exhaust your federal student loan options before ever considering private loans. A helpful guideline when thinking about how much debt is reasonable is to aim to borrow no more in total than you realistically expect to earn in your first year's salary after graduation. If your chosen career path has an average starting salary of $50,000, you should be very cautious about taking on more than $50,000 in total student loan debt. This helps keep future monthly payments manageable. Finally, it's a team effort. The student has a major role to play in keeping costs down. This includes making smart choices about which school to attend. An in-state public university is often a fraction of the cost of a private or out-of-state one. It means diligently applying for private scholarships, which are offered by thousands of organizations. And it can mean considering options like attending a community college for the first 2 years to save on tuition before transferring to a 4-year university. Navigating the cost of college is a journey. It requires a long-term savings plan, a yearly commitment to seeking financial aid, and a sober, realistic approach to borrowing. By starting early and staying informed, you can make this dream a reality without it turning into a financial nightmare. Over the past 14 chapters, we have covered an immense amount of ground. We've built a complete financial toolkit. In our final chapter, we will bring everything together, review the core principles of financial literacy, and discuss how to create a lifelong habit of financial well-being. I'll see you there. Hello, and welcome back for the final chapter of our journey together. If you have been with us from the beginning, I want to take a moment to sincerely congratulate you. Over the past 14 chapters, you have invested your most valuable asset, your time, in yourself and your future. You have absorbed an immense amount of information, from daily budgeting to long-term legacy planning. Today, we will not be learning a new, complex topic. Instead, we are going to bring everything together. We're going to talk about how to transform this knowledge from a series you listen to into a sustainable, lifelong practice of financial well-being. Before we do, allow me to share our guiding principle one last time. This entire series, from the first chapter to this one, has been created for educational and informational purposes only. The concepts discussed are general in nature and are not a substitute for personalized, professional advice. The financial, legal, tax, and insurance landscapes in the United States are complex and governed by specific laws and regulations. As you move forward on your journey, please continue to build your team of qualified, licensed professionals to guide you in your specific decisions. Financial literacy is not a destination you reach, like a graduation. It is a set of habits and a mindset that you cultivate and practice for the rest of your life. After all of our discussions, it can be distilled down into 5 core, actionable habits. The first habit is to live with a plan. This is the practice of mindfulness. It all goes back to what we discussed in Chapter 2, the conscious spending plan. This is the habit of telling your money where to go instead of wondering where it went. It's about taking the time each month to look at your income and your expenses, and making intentional choices that align with your values. It's the difference between living on autopilot and being the pilot of your own financial life. The second habit is to prioritize your future self. This is the practice of intentionality. It's the discipline of paying yourself first. Before you pay for discretionary wants, you set aside money for your long-term goals. This habit is your financial offense and defense, rolled into one. It means consistently funding your emergency fund to protect against shocks, methodically paying down debt to free up your income, and most importantly, making regular, automatic contributions to your retirement accounts to build your future. The third habit is to embrace the power of time. This is the practice of patience. As we learned when discussing investing and retirement, the most powerful force for wealth creation is not picking the perfect stock or timing the market. It is the slow, steady, relentless magic of compound growth working over decades. This habit requires you to zoom out and adopt a long-term perspective. It's the understanding that true wealth is not built in days or months, but in years of consistent, disciplined saving and investing. The fourth habit is to protect what you build. This is the practice of prudence. Building a strong financial house is wonderful, but it must be protected from life's storms. This habit involves regularly reviewing your financial armor. It means ensuring you have the right types and amounts of insurance, health, auto, home or renters, disability, and life, to shield you and your family from catastrophic loss. It also means having a basic estate plan in place, as we discussed, to ensure your wishes are honored and your loved ones are cared for. And the fifth and perhaps most important habit is to stay curious. This is the practice of lifelong growth. The world of finance is not static. The economy changes, tax laws are updated, new financial tools are developed, and your own life will go through many seasons. Cultivating a habit of continuous learning by reading reputable books, listening to educational podcasts, and staying informed ensures that your knowledge will grow and adapt along with you. Beyond these habits, true financial literacy creates a profound mindset shift. It moves you from a place of fear and anxiety about money to a place of confidence and control. It helps you see money not as a source of stress or a measure of your self-worth, but for what it truly is, a tool. It is a tool to provide for your family, a tool to achieve your dreams, a tool to have new experiences, a tool to be generous, and a tool to build a life of security and freedom. The money itself is not the goal. The life it helps you create is the goal. We have covered so much ground that it can feel overwhelming to think about where to go from here. The secret is that you do not have to do everything at once. The goal is simply to build momentum. So I will leave you with one final piece of encouragement. Choose one thing, just one, and do it this week. Maybe your one thing is to finally sit down and sketch out your first spending plan. Maybe it's to check the beneficiary designations on your retirement accounts. Perhaps it's to have that first, open conversation about money with your partner. Or maybe it's as simple as going to your local library's website and reserving a book on personal finance. Small, consistent actions, compounded over time, are what create extraordinary results. Thank you for joining me for this series. You have equipped yourself with the knowledge to fundamentally change your life. The journey you started with Chapter 1 doesn't end here. It begins here. You have the map. You have the compass. The path ahead is yours to create. Go forward with confidence.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.